Welcome, beautiful people, to another installment of your Wealthy Wallet Wall Street course. I hope you had an amazing week because I know I did. I was definitely into the week in green after being in the red 2 weeks in a row after the market decided to do a correction for 2 straight weeks in a row. But I hope you had an amazing week. I know that I was up a lot, so I'm definitely thankful for last week. I know Friday was a little mixed. Stock was up, then it was down, and you got all these beautiful things happening. But ultimately, it's always a good thing if you can end each week in the green. So, family, I hope you ended the week in the green. And I'm thankful for you being with me here on a Saturday because you could be anywhere, especially partying as all these economies are starting to open back up. But instead, you're here with me on a Saturday, learning how to make millions, right? Learning how to make money to secure generational wealth for you and your family. But I don't want to keep you long. So let's dig into it. How to analyze a financial statement. Well, now we're going over part two. So we're going to start off part two. We're going to start off talking about earnings per share. What is earnings per share? Earnings per share compares a company's profit to the average number of shares that it has, right? It is the return on each share owned by investors. So you cannot compare. So no, before I dig into that, so it is the return on each share owned by investors. So if a company earns $2 to $3 per share, then that's how much share that you earned over that period of a year, right? So each share, if the company earned $3 per share, then you earn $3 on your investment of each share that you held throughout that company for a whole year, right? That's how much actual money you earn. Not how much the share price went up, but how much actual money that you made as an investor. Remember, we talked about in class number one that when you invest into a company, you invest into fractional ownership into that company. You're a part owner of the company, and as a part owner, you should know how much you make on each share of the company, right? And then you cannot compare one company's EPS to another because of the difference in the number of shares, right? So one company can make 40 million and another company could make 40 million, but the earnings per share will probably be different because they have different amount of shares, right? And if one company has 100 million shares and the other company has 50 million shares, then the company with 50 million shares earnings is going to be bigger than the one with 100 million shares, right? Because numbers don't lie, right? Numbers don't lie. So how do we calculate earnings per share? And not only we calculate earnings per share by taking the total comprehensive income, which is the bottom line income, I'm sorry, and you divide it by the average number of original shares, right? And we get the number of original shares by taking the beginning share price, right? I mean, the beginning shares of a company, meaning the shares that it end with in the previous year and the shares that it end with in the latter year, right? And you divide that by two to get the average number of total shares, right? But a high EPS tells us that the company's making money. This is why it's important to know what an EPS is. An EPS tells us whether the company's losing money or making money. So I know that an EPS with $5 is making money. I know that a company with an EPS of $10 is making more money than a company with an EPS of $5, right? But I know that a company with an EPS of -3 is losing money. This company's not making money on the sales that it's generating because its expenses and its cost to produce that product outweighs the money that they're bringing in, right? That's what a negative EPS means. So a negative EPS means that their cost of goods or the cost of revenue, the cost to create the product, the cost to market the product, is outweighing the revenue that's actually coming into the company, the profit that's coming into the company, right? So if it's outweighing that, these people are going to have a negative earnings per share. And a negative earnings per share don't necessarily mean that it's a bad company to invest in, especially if they're creating things in the future. So if they're creating things 10 years before people actually know that they need it, then that might be a good thing, right? It's like Tesla. It took Tesla 14 years to make money, right? It took them over 14 years to make money, but they were investing into the future And sometimes it takes people a little bit longer to catch up with things they actually don't know they need into the future, right? They don't know. They didn't know that they needed electric cars, but electric cars, EV cars, are gaining momentum worldwide. They're increasing in sales 82% a year, right? And since electric vehicle sales are increasing in sales 82% per year, even though the company's losing money, I know that they're going to dominate the market in the years to come. So, earnings per share, a negative earnings per share don't necessarily mean a bad thing. It just means that people has not adopted the new way of life yet or the new world yet, as per se. But I want you to understand that if a company's losing money and their business model is something of the past, then you probably should not be investing in a company because it's only a matter of time before they file bankruptcy. But if the company's losing money on earnings per share because they're investing in something that people don't understand yet, and that's a big part of the future, and their model is a big part of our future coming, right? Then that's probably a good company to invest in. And as a matter of fact, you might be catching it on the low. You might catching it when it's all the way down. And when everybody else jump in because they finally get familiar with it, you're going to be making thousands of dollars because you understood the model of the company before everybody else did, right? But at the end of the day, an EPS always tells us whether a company's making money or losing money. And it doesn't mean it's a bad thing if it's losing money, and it doesn't mean it's a good thing if it's making money. But you want to know those things because you want to know the future of the company and the company you're investing into. How much money am I going to make per share that I buy into this company? Because again, you are an investor. And as an investor, you need to calculate the numbers, right? You always want to know the numbers because the numbers don't what? The numbers do not lie. So if you want to know the numbers, then you got to know the EPS. So let's calculate the EPS, right? Let's talk about it. Let's calculate the EPS. So let's go to Apple. How do we calculate the EPS? All right, so we calculate the EPS. Let's write it down real quick. Let's write down EPS. EPS. Let's write down the EPS. Make it big and bold like we always do, right? Write down the EPS. EPS always equals what? EPS. Let's go back. What it tells us that the EPS equal, right? You need this. You need the total comprehensive income divided by average number of original shares, right? So let's go back to it. So we need to know the income, the profit, and the number of shares opened, open, opened, opened, and the number of shares closed. Let's make it all bold and beautiful, right? Bold and beautiful. Expand this out a little bit more. Bold and beautiful. So what is the profit? We got the profit right here. Let's copy and paste the profit. Boom. All right. Now let's go to Apple. As we continue on the same thing, you'll find the open number of shares not on the balance sheet. So let's click on the balance sheet. So we know that the open shares will be the shares that the company ended at the previous year, right? So let's copy and paste. Let's copy it. Let's go paste the open shares and go back and we paste the closed shares, which was 16 billion, and then we place it right here. Boom. And let's make this all bold and beautiful, just like the other one. All right, they want to put EPS right where we can see it. So EPS, again, let's make it bold and beautiful. EPS, we know that it's made up of profits, so let's copy it, profit right up under it. And then right up under this, we're going to do equal, right? We got to divide these two. We want to know the average. So you type in average, average. Then we select these two. We need to know the average of those two. And that's what it is. Put it right in the middle, make it nice and bold, make it 12. All right, so how do we get the EPS? We're going to equal again. And you're going to take the profit, and we want to divide it by the average of original shares, which will give us the EPS. And we want to turn this into a number. All right, so you got a number. So it lets me know that the average EPS is $3.30. So how much did people make per share that they own of the previous year? $3.30. That's how much they made. They made $3.30 per share the previous year, right? Not the trailing 12 month, but the previous year they made $3.30 on every share that they own. That's how you calculate the EPS. And you need to know the EPS so that you can really calculate the PE. What is the PE? Let's talk about the PE real quick, because the PE is the reason why that we need to know the EPS. The price to earnings ratio compares income to the current market price of the company's shares. It is an investor perception of the company, right? This is why we always want to know the PE of every company, because it's the perception of the majority of the people. So if a so what I mean is a price to earning ratio of 10 means that investors pay 10 times current earnings per share to buy one share of the stock. So if people are willing to pay 10 times more for a share of stock of a company than it's usually worth, then it shows you that people are optimistic about that company, right? Because they're willing to pay 10 times more than what the company actually earns. And people who are willing to pay 30 times more, 40 times more, or 50 times more are even more enthusiastic and optimistic about the future of this company, right? So a company that has a PE ratio of 100 and its current share is at $5, right? So people, I mean, its current EPS is at $5. People are willing to pay a lot more for this company. And that's why it's important to know what a PE is of every single company. A PE ratio of 22 or below tells me that a company's undervalued. Why is that? Because I know that the average PE ratio is between 23 and 26. So the average ratio, PE ratio of every company is between 23 and 26. Then a company that is at 22 is undervalued. But a company that's PE ratio is below 10, people are not so optimistic about. So I might think twice before investing into a company with a PE ratio of less than 10, because a PE ratio of less than 10 is people's perception that is this company might not be around in the future. This company might not exist for much more longer. This company might be on the brink of bankruptcy because these people are not very optimistic about this company because it has a PE ratio of 10. People are not willing to pay 10 times, 20 times, 30 times, or 40 times more for this company because they don't believe in the company's future. But the majority of people that believes in a company's future believes it because they are willing to pay an enormous amount for actually what the company is producing. I think Tesla's PE ratio right now is over 900. So people are willing to pay 900 times what the company is actually earning, right? So people are super optimistic about that company, right? But a company with a PE ratio of 6, people are not even remotely optimistic about the company. And it's not that that company's undervalued, it's that that company's on the brink of something happening. And if nobody believes in it, nobody's going to invest in it. And then if you don't have investors to continue to help the company run while the company's not making money, then it's only a matter of time before that company files bankruptcy. It's, again, folks, it's common sense, common sense and calculation. Common sense and calculation, that's everything. Common sense and calculation. So common sense tell you if the company's not making money and people don't believe in it, why would you invest in it? Right? So anything below a 10, I probably wouldn't be taking a look to invest in it. But if they have a PE ratio of 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, then to me, this company's undervalued. So I'm gonna do my due diligence, right? I'm gonna look into the company, seeing why it's undervalued. Maybe they have a business model that people don't understand yet. And if they have a business model that people don't understand, and I can see it potentially as a company that's going to thrive in the future, then I'm going to invest in it because I did enough research to understand that people don't understand what this company is creating. It's like Palantir. Many people don't understand the company Palantir, and the ticker symbol is PLTR, right? They don't understand how this company operates and how this company works, right? But I understand how it operates, and I understand that people are going to need to make sense of data. And if people are going to need to make sense of data, they're going to have to continue to hire Palantir, right? Because Palantir helps them to create millions and hundreds of thousands and millions of dollars by using their data in a way that will help them or the company grow. And people don't understand how Palantir works. Palantir helped catch Bin Laden, but people don't know that. But if you want to understand how a company actually works, then you have to do due diligence. So you know that the company is undervalued, but do you know why the company is undervalued? Right? You got to know those things. Why is the company undervalued? I want to know why the company is undervalued. And if you find a good reason for the company being undervalued and you're about to buy the company in an unvalued state, then you're going to reap all the rewards when everybody else start to jump in because now they finally understand the company and they start to become optimistic about the future of the company. So they're willing to throw their money in, they're willing to invest into it. And you invest into it when nobody thought about it. You invested into it when it was undervalued, right? So now the PE ratio is at 50. So, and you got in when the PE ratio was at 12. So you see where it goes? You'd earn, 38% increase in people's perception of the company. And guess what that means for the stock? It's going to go up a lot. It's going to go up a lot. It's going to go up a lot. So how do we calculate companies' PE, right? Price to earnings. How do we calculate that? Let's go into that real quick. How do we calculate a company's price to earnings? Let's go into this. Company's price to earnings is called, let's type in, it's called PE. Let's make the PE about right here. The PE. I want to make it a little farther down. I'm sorry. So let's make the PE. What is the PE? Price to earnings. And there's a reason why we definitely need to know price to earnings, as I just explained to you. Price to earnings. In order to calculate the price to earnings, let's do PE. Right. Let's make it big and bold. Price to earning ratio. We need the actual current share price, right? Current share price and EPS. Make these big and bold. So again, we need to know the current share price. One. So we need to know the current share price. What is the current share price of Apple? 121.03. So the current share price of Apple is 121.03. And then the EPS is what? 330. 3.30. So the current share price is 121 and the current EPS is 330. So let's go ahead and make this bold. Right? Boom. All right. So how do we get the PE ratio? We go equals. Remember, you got to type the equal sign. Equals current share price, right? Divided by the EPS. And what do we get? Let's turn this into a quick number. Make it big and bold. We get 36.68. So people are willing to pay 36.68 times Apple's current earnings. They're willing to pay 36 times Apple's current earnings. So it shows you what? That people are very optimistic about the future of Apple, right? especially when a company can make $2 billion in an economy that's in a pandemic, right? These people are able to pivot, adapt, and innovate, right? They are able to continue to go. But remember, they're the first company that made it to 1 trillion. They're the first company that made it to 2 trillion. And they're going to be the first company to make it to $3 trillion, because at the end of the day, Apple's a beast. And I'm telling you personally, I know that I'm willing to pay, 36 times Apple's current earnings, because I believe in the future of the company. That's why I'm an investor in the company, because I believe that it's going to be around in the future and it's going to continue to print money like it's doing. And as an investor, you want to know these things, because at the end of the day, you putting your hard-earned money into these things, and you hope into this company, and you hope that it makes money for you, right? But we understand that the majority of the people are very optimistic about Apple, so they're willing to pay 30 plus times more than what Apple is currently earning per share, than what Apple is currently being perceived to be worth earning at its current earnings per share, right? So, and if it's worth that, then, and everybody's optimistic about it, and I understand from doing my due diligence that this company is an amazing company. And of course, I wanted to pay 30 plus times more than what the company is actually earning. Why? Because I believe this company is going to earn 30 times more than what it's earning now in the future, right? Because they continue to thrive. And I've done enough research to understand, and enough analysis to understand that the company's making money. It's on an uptrend, right? It's on an up trajectory. It's not on a down trajectory. And I know that it's been a solid company since its founding way back in the 1980s, right? Apple is truly a beast, right? So let's move on. Now that we understand price to earnings ratios and what it means. Now let's talk about a liquidity analysis, right? What is a liquidity analysis? A liquidity ratio analysis is the use of several ratios, but we're going to just use two, to determine the ability of an organization to pay its bills in a timely manner. We know that we want to know that if giving certain circumstances and problems, can Apple pay their bills, right? This analysis is important for lenders and creditors. Remember, you are an investor in the company, and you want to make sure that a company has a solid reputation so that they can get money from lenders and creditors to continue to expand their business, right? Because this is how we expand our business. If you don't got no money to expand your business, how are you going to grow, right? If you don't got the money to buy products, manufacture products, buy the building, or buy the plant equipment, how are you going to continue to grow, right? But if you got enough resources to go get the money when you need it, then I know that you're going to continue to expand. But people who don't have the resources available to continue to go and get money from other companies or other creditors or lenders to grow their business, I know that this is a dying company and people don't believe in it, right? Because they look at their balance sheet and they say that they're just too overweighted. They're too overloaded, right? This is a ticking bomb waiting to blow up, right? So we want to understand a company's literally debt load, and we want to gain some ideals of their financial situation of a borrower or customer before granting them credit. This is why lenders want to know what's going on, right? And so the first ratio we use is the current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year, right? So it basically so what a current ratio is, the measure of a company being able to pay its bills within a 1 year period. If anything happened, any circumstance came up, can they pay all their bills within a 1 year? It tells investors and analysts how a company can maximize their current assets on its balance sheets to satisfy its current debts and other payables that needs to be paid. And then the way to do that is we take your current ratio, right? The current ratio equals current assets divided by current liabilities, right? So let's go ahead and do that on our spreadsheet. Let's do that on our spreadsheet. All right, so we want to take it. Let's go back right here. So I want you to type in inventory. And then I want to type in current assets, current liabilities, current liabilities. Space that a little bit bigger, right? I also want you to type in cost of goods sold. I need you to type in all three of these things. We're gonna go over what this all means. So make it bold and big like we do everything. So now let's go to Apple. And let's go find. Remember, we're gonna go to the balance sheet in order to find these things. So we want to know what the current assets. First, we want to know what the inventory is. So we click on current assets, and then you maximize current assets. So we want to know the current assets for 2020. But first we want to know the inventory. So we go to the inventory, put the inventory in, boom. And now we want to know current assets. Then you want to know current liabilities. So we go back to Apple, and then we get the current liabilities. So minimize that. Then we go to liabilities, current liabilities. Then we need the cost of goods. So we go to the income statement. It's actually the cost of revenue, 2020, right? We'll make all this big and bold. Boom, boom, boom. All right. Then you go on and type in current ratio and quick. Well, before we do that, let's do current ratio. All right. So how did we come up with the current ratio? Again, we'll go equals. In order to get the current ratio, we need to figure out if Apple can pay its bills if they had to liquidate everything and pay all their bills within all their short-term bills within 1 year. Could they pay all their short-term bills in 1 year? This is what this current ratio is about to show us. If they ran into a situation or a circumstance that caused them to have to pay all their short-term bills within 1 year, could they pay their bills, or could they pay their short-term debt back within 1 year? Let's find out. So you'll take your current ratio, and then you'll go equals. We're going to take current assets minus current liabilities, right? And we see this equation comes out L7 minus L8 because the numbers are in the L row, column 7 and column 8. So what do we get? I said minus. Divided. I'm sorry. Divided. I'm sorry about that. I meant minus. Then we turn it into a number. Right? So it shows me that Apple can pay 1.3 times over its bills if they had to liquidate everything within a 1 year period and pay off all their short-term debt, right? So I know that they can pay the short-term debt 1.3 times over, right? So they can pay the debt 100% over and still have 0.3 left of assets, right? So Apple don't have no problem paying their bills if they had to pay their short-term debt within a matter of a year. It shows me that they are able to pay short-term debt in a matter of a year, right? And you want to know if a company can pay a short-term debt, then they got some liquid. So then that liquid can be used to invest in something that they need highly bad. Like if they find a company that they might want to acquire that's up and coming startup that might be a big thing in the future, they have the money free and they have enough money free and enough money to pay their debt if a circumstance happened to where every company wanted their money on a short-term debt at one time. Apple still have enough money left over to acquire another company if they need to, or just produce more products, whatever they need to do with the access money, right? We want to show that Apple has the money to be able to do it, the liquidity to be able to do it. And this shows you, the current ratio shows you, right? And that leads us to the second ratio, quick ratio. The quick ratio, also known as the asset test ratio, offers insight into how well a company can meet its short-term obligations or immediate obligations, as in chemistry, right? An asset test provides fast results, right? Showing how quickly a company can convert short-term assets to pay short-term liabilities. Essentially, it's a measure of a company's liquidity, right? So how do we get this liquidity? Right? We want to know the liquidity. Let's go back. Let's go back to where we was. All right, let's type in quick ratio. Quick ratio. So how did we get the quick ratio? How do we know Apple can pay their bills in 1 month if they need to, or within 1 year, 6 months, 3 months? Can they pay their bills in 3 months? So we're going to do equal, and you want to take your current assets, right? We're going to do, how about that? Your current assets, and you want to minus that by your current inventory, because at the end of the day, if you need to turn all your assets and everything you need into liquid, into actual currency or a form of money immediately, you might not be able to do that with the inventory, because at the end of the day, it's going to take you some time to sell off that inventory, right? So I don't want to use inventory as a means of getting quick liquidity, right? So if Apple had to sell all their products at one time, all those iPhones, computers, iMacs, AirPods, if they have to get rid of them in 3 months, they're going to have to do a stupid sale to get rid of all their inventory. So then again, it won't even be for $1 billion in inventory. It might be $2 billion, because they have to adjust the cost of the inventory in order to get rid of it very fast. That's why I don't want to include inventory in the actual liquid that a company might need if they had to come up with liquid in a matter of a month or a couple of weeks or 2 months, right? You don't want to include inventory in that. So then that's why we're going to take the current assets minus the current inventory, and we're going to divide that also by the current liabilities. And what do we get? We get 1.32. Let's turn it into a number though. When we turn it into a number, it actually come out to 1.33. So Apple had to pay off all their debt, liquidate everything and come up with some liquid. We know that they can pay off 100% of their current debt, and they have about 0.33 in liquid of their assets left, right? So it shows me that Apple has the ability to come up with 0.33 of liquidity after they pay out all their short-term debt, or that's what it means to me, right? So at the end of the day, it shows you that Apple has got the money. They're ready to go. They're ready to play the big boy game, as they have been doing since the 80s. They're continue to be a company of growth. Remember, Apple made $2 billion in a pandemic. There's not many companies out there that made $2 billion in a pandemic last year, right? So it shows you Apple's ability to be able to pivot to also make money off their assets, as we've seen in return on assets and return on equity, right? We showed that Apple's being able to manage the money that's given to them by people like me and you, who have fractional ownerships that buy shares that make money off their equity, made 73%, So it shows us Apple's ability to be able to make things happen, to be able to pay off all their debts. And if they need liquidity, they can get access to it pretty fast, right? Because it just shows us they got more than enough to pay their bills. They can pay their bills 1.3 times over their short-term debt, right? All right, so now that we know that, let's move to last but not least. After we just learned the quick ratio, we want to move to inventory turnover. We want to know how well a company's doing by how much inventory they are turning over, right? Inventory turnover is the rate at which a company replaces inventory in a given period due to sales, right? And why do we want to know this? We want to know how fast they move in product, right? We want to know how fast they move in the weight. This is why you want to know it, because if the faster they turn over the product, the more profit that they're making, the more money that they got generating, the more income that is coming in, right? The faster you sell something, the faster you make money. Calculating inventory turnover help businesses make better pricing decisions, better manufacturing decisions, better marketing decisions, because we understand that if our inventory is turning over pretty fast, then we got a good price. And it shows that if our inventory is turning over fast, it also shows that other people are talking about it, right? Because our quality is good, right? And then it shows me that it's been marketed right? Because people are buying it, right? And it helps us, the people or consumer, make purchasing decisions, right? And it helps us to make purchasing decisions based upon the product we're selling, right? Because how fast we turn it over, right? Well managed inventory levels show that a company's sales are at the desired level and costs are controlled. We want to know that we got a great cost on something, and we're selling it for a specific price, and that we got a great margin, and we're learning how to scale, right? Based upon how well our sales are, how well our inventory continues to turn over, right? And the inventory turnover ratio is a measure of how well a company generates sales from its inventory. So how do we figure out inventory ratio? We take the cost of sales and we divide it by the average inventory. So let's do it. Let's see how well Apple's doing in turning over his inventory. Let's see how many times Apple turned over his inventory in 1 year. So in order to get there, we take the cost of sales, right? So let's put right here, inventory, T/O, and the days. Uh, Inventory TO, T/O. Oh, all right. So let's do it. So what we do, we says we take the cost of goods, right? And you divide that by the average inventory. And what do we get? Turn it into a number, right? Too many zeros, too many zeros. We don't like all zeros. So it shows me that Apple turns over its inventory 41 times a year. It turns over its inventory 41 times a year, which is pretty amazing. And the higher that number is, the even better it is, right? So if a company turns over its inventory only one time a year, that company's not doing too well. Two times a year, that company's not doing too well. Three times a year, it's still not doing too well, you know? So you see a company that turns over its inventory 41 times a year, that company's doing pretty super. That means all the inventory that it gets in 41 times, it sells all out 41 times. 41 times the company sells all out of its inventory. That's what we want to know. The company sells out of its inventory 41 times a year. That's a good thing. And remember, the higher that number, the better it is. If a company only sells out of its products 3 times a year, that's not that good, right? Unless they sell something majorly expensive where they have a 50 to 60% margin, then that's pretty good, right? But a company that don't have that big of a margin, and they're not making it, and they don't have a big expensive luxury product, and they only turning over their inventory 3 times a year, that might not be that good. But a company that's making $200,000 or $300,000 for turning over their inventory, for each product, then that's probably pretty good. That's why you always got to do your DDD, and it always have to be relevant to the company, right? But if a company is making $3 to $4 in margin, or $100 in margin per product, and they only turn over their inventory 3 times a year, that company's not making much money. They're not doing very well. But a company like Apple, who turns over their product 41 times a year, they're doing pretty great, right? So, but let's figure out how many times they turn over their inventory in a matter of days. So we take 365, first you do equal 365 divided by the total amount of days that they turn over inventory, right here. And boom. So it shows me that Apple turns over their inventory every 8 days. Every 8 days, which is pretty good. They turn over their inventory every 8.5 days. Let me say it again. Apple turns over their inventory every 8.5 days, which is an amazing thing. So they buy a product in 8 days, they can sell out all of it, right? So let me say it again. They buy a product, they create a product, manufacture a product, and in 8 days, they sell out of it. That's the stuff you want to know. That's the stuff you want to know, right? Because at the end of the day, it shows you their ability to make money, family. And I hope you learn that you do this with every single stock that you invest in. Because once you get this down to a science, you can create this less than 5 minutes. You create a horizontal analysis, a vertical analysis, EPS, a PE ratio, the inventory turnover, right? You can create ROE and ROA quickly, right? And I'm going to show you why you're going to want to know these things, because next week we're going to learn how to do price target predictions, right? Just like the big people do. We're going to learn how to predict. Uh, we're going to learn how to predict the future price target of a company. When we evaluate the company, we're going to learn how to predict the future price target, the PT of a company. You have your own PT. So I expect this stock to get there about this time, which will be pretty amazing when you have a price prediction for a company, right? Price prediction, a price target. And that's what we're going to learn next week. But I hope you had a wonderful time with me this week. I don't want to hold you any longer, but definitely practice on this. What we learned, go ahead and use this as part of other companies. And remember, you can always holler at your boy just by DMing me or posting a comment down and get with me. I try to get to everybody, because at the end of the day, I want everybody to earn wealth and create generational wealth for you and your family. Again, I will see y'all next week. I hope you have enjoyed, and I will see you next week at the same time, family.